Okay, let's dive right into this explainer on a massive psychological trap in trading. Why do high win rate strategies still manage to lose money? Now, a really quick reminder up front, everything we're covering here is strictly for educational purposes. It's definitely not financial advice and absolutely not trade signals. We're really just here to break down the underlying math and psychology so you can approach your next session with absolute precision. All right, let's get into it. Picture this. You're sitting at your desk and the market just moved aggressively against you. It completely disrespected a setup you usually rely on. So you look at your journal and you realize you've actually had a solid string of green trades this week. You're just frustrated, right? Sitting back in your chair asking yourself, if I'm winning 80% of my trades, why is my account shrinking? It's at this exact moment that panic starts to override your valid plan. You start questioning literally everything. And this confusion sets in because, well, culturally, we're conditioned to believe that winning most of the time equals success. But in the markets, that logic is fundamentally flawed. If you've ever felt that frustrating disconnect between how often you're right and the actual balance in your account, trust me, you are experiencing something incredibly common. So what's really interesting here is that there's a completely normal psychological mechanism behind all this frustration. We call it win rate bias. It's basically this very human tendency to overvalue how often we win while completely ignoring the overall size of those wins and losses. And notice how I said this is a normal psychological mechanism. This is absolutely not a personal failure. We're literally hardwired to seek out that dopamine hit of being right. But in trading, this bias quietly destroys your attention and your execution quality. Think about it. When a trader overvalues their win rate, they just start ignoring risk and reward. They'll snatch profits way too early just to secure a guaranteed win, and then they'll let losers run because they simply don't want to accept a loss that's going to ruin that precious win percentage. Just acknowledging this bias is your absolutely vital first step to neutralizing it. And this brings us to a fascinating crossroads. It brilliantly highlights the exact difference between letting that bias trigger an emotional reaction and calmly executing a valid plan. On one hand, you have the emotional reaction, panicking when a high win rate setup fails. Because you're so used to that setup working, its sudden failure feels like some crazy anomaly, and that often leads straight to revenge trading or just freezing up completely. But contrast that with a valid plan. This is the trader who pauses calmly after a market move to review their risk and reward. They aren't panicking because they aren't relying on this illusion that they have to win every single time. They recognize that a loss is just a business expense. It's a simple statistical probability playing out. Moving from that reactive, emotional state to the calm execution of a valid plan, well, that's the entire game. So, the crucial point we're getting to is that win rate alone is completely incomplete without factoring in your true trading expectancy. Expectancy is just the mathematical reality that combines your win rate, your average win, and your average loss. That's what determines the actual true results of your strategy over time. Think of it like this. Win rate is just how often you're right. But expectancy, that tells you how much you can actually expect to make or lose on average for every single trade you execute. It's the exact same math casinos use to stay incredibly profitable, even though they're losing individual hands all day long on the casino floor. They have a positive expectancy. You could literally have a trading strategy that only wins 30% of the time, but if your average wins are massive and your average losses are tiny, your expectancy is highly positive. On the flip side, you could win 90% of the time, but if your expectancy is negative, you're on a slow, agonizing path to blowing your account. When you really think about how this builds, the trap becomes incredibly obvious. Even if you win the vast majority of the time, if your average loss completely dwarfs your tiny average win, your strategy is just going to continuously bleed money. Let's say you take 10 trades. You win 9 of them, making $10 each time. You feel like an absolute genius, right? But then on that 10th trade, you lose $100. Your win rate is an impressive 90%, but your net profit is negative $10. You worked hard, you were right almost all day, but the underlying math was just quietly working against you the entire time. And here is the really dark side of win rate bias. When you ignore expectancy and just blindly chase high win rates, you drastically increase your risk of ruin. Risk of ruin is exactly what it sounds like. It's the statistical probability that ignoring those payoff sizes will eventually wipe out your entire trading account. Because when a trader is focused solely on being right, what do? They often move their stop losses further and further away, just to avoid getting taken out of a trade. They're taking on more and more risk just to keep that win rate artificially high. This means a few bad trades, or honestly, even just one really bad, highly emotional trade where you refuse to cut the loss, can mathematically erase months of disciplined hard work. The market will always eventually expose a strategy that carries a high risk of ruin. So how do we fix this? To respond with calmer, more disciplined process behavior before your next session, Simply follow these 3 clear steps to reset your focus and maintain your execution quality. Step 1. Pause after a market move. Don't react. Just take a breath and observe what the market is actually offering. Step 2. Prioritize payoff size over winning often. Honestly ask yourself if the risk-to-reward ratio actually makes mathematical sense before you ever click that buy or sell button. In step 3, which is the absolute ultimate practical takeaway from this entire explainer, track expectancy, not only win rate. Change the metrics in your trading journal. Stop staring at that win percentage column and start obsessing over your average win versus your average loss. Because when you change what you track, you change what you value, and that completely rewires your psychological approach to the markets. I want to leave you with this final, provocative reflection to really test the resilience of your plan and encourage you to prioritize mathematical expectancy over emotional reactions. Ask yourself right now, would your strategies still work if your win rate dropped by 10%? If your answer is no, or if your answer is that would literally blow up my account, well then your strategy is far too fragile. It means you're relying on perfection in a market that is inherently imperfect and unpredictable. Take this question to your backtesting. Take it to your journaling. Build a plan that is robust enough to survive inevitable losing streaks, because that is the true hallmark of a professional, mathematically sound approach. Thanks so much for joining me for this explainer. And remember, trade the math, not the emotion.